Hey everybody, happy Friday. Happy Friday. Yes, thank God it is Friday, right? The roller coaster continues with no rhyme or reason. We were just almost at the flat line in the S&Ps literally just a minute ago when Powell finished speaking. Now we're back down about 20 points or so, well off the lows that were down, I want to say 65-ish or so. Um, this is just the constant news source, this constant fluid news flow that we've been talking about that we have to be used to, guys. It's not changing anytime soon. Absolutely not changing anytime soon. All right. So, how's everybody doing today? Sound good? Everybody can see me okay? Hello, Steve, Lisa, Guillermo, Gene, everybody else popping in now. Awesome, awesome, awesome. All right, guys. Well, today, like I said, it is TGIF. It is TGIF day because it's been a long week for everybody. And thought we would still have education today, but make it real. Oh, Ralph, that is really nice of you. Thank you, buddy. Thank you, thank you. See, and now you can talk, right? Someone must have helped you, Ralph, on your chat. So it must be all good. Um, so definitely wanted to have education, but have a little fun today as well. All right. So would love for you guys to all smash that like before we get going here. And before we get into our test and quiz. All right. Before we get into our test and quiz. Wow, you guys, I didn't put up word of the day yet. Does that look like Hulk? But to give you a preview, since you're all pretty smart, yes, that is the word of the day today, or the acronym of the day today. We'll get that out there. All right. So, what I want to do today is throw out a little quiz. Okay? So, you're going to have to be working on the fly here, everybody. The first one to come up with the right answer to each of these will win some swag. Okay? You get one guess. This is the first right answer, but I will walk through how we figure out each of these. The first one is a delta quiz. Can everybody see this on the screen? Excellent. Okay. This is a delta quiz. We are going to take this position of selling this put over here, the March 14th 340 strike put, and at the same time buying the March 21st 320 put. Okay. Our trade price, as you can see here, is a credit of 518. And the current stock price is 335. Okay. If the stock moves to 330, what will be the new value of this position? Everything you need is on the screen here. Everything you need is on the screen. Okay. I'm going to just kind of talk about the market while you guys are all figuring this out. And then as soon as I get a right answer, we will go through how we figure that out. SPY just turned positive. Sure, I'll remove everything off of here. There you go. SPY just turned positive. Now up 5 points on the day. It's a huge, huge turnaround. We will see what happens. Okay, Bear came up with an answer. Don't know if that's right or wrong, everybody. So give me your answers here. Okay, give me your answers. And if you're within a penny or two because it's a rounding error, that's fine. Okay, that is fine. Okay, anybody besides Bear? SMCI just ticked positive. SPY is really rallying right now. NVIDIA just turned positive. Apple is up huge. Google turned positive. Okay, Thomas, you've got 518. We'll give it another minute or so, and then I'll walk through it with everybody, and we can move on to the next one. So what is the proper way to calculate how much the value of an option, or in this case, how much the value of a spread will change as the stock moves? What do we need to look at? Yes, I'm looking off to the side here, everybody, because I'm just watching the market and quotes here. Q's just went positive. That was the toughest one of the day, the NASDAQ. That just went positive. Okay, delta, excellent, excellent. So what is the delta of this spread? Okay, the delta of this spread, we have a 54 delta on the option that we sold. If we sell a put option, I'll keep going, Bear, until my gums hurt. If we sell a put option, that gives us positive delta. Okay, so the put option that we're selling has a 54 delta. So that gives us positive 54 delta. Now the option that we're buying, the March 21st 320 put, has a delta of 30. If we buy a put, that's negative delta. So the net delta to this spread is 24. Okay, it's 24. Everybody with me? Okay, so that means for every dollar the stock moves, the value of this position is going to move by 24 cents. So if the stock moves to 330, that's a $5 move. 24 times 5 means the value of the position will change by $1.20. It will increase in value by $1.20, bringing the value, as Bear said first, to 638. Other way around, Gus. You had the $1.20 right pretty much, but other way around. Okay, Bear, you can still answer, but you're locked in with one prize. We want to spread the wealth around. Okay, did everybody follow that? Maybe not as quickly as some other people may have been able to calculate this, but did everybody follow? You're a contrarian. I love it. Did everybody follow how we figure that out? Great. Let's move on. Let's do a Vega quiz. Okay, let's do a Vega quiz. Here, this is just a simple calendar call spread. Okay, it's a 1 week calendar call spread. Selling the March 14th, 165, buying the March 21st, 165. We're doing that for a price of $1.33. Okay, now in this example, I'm just going to give you a clue here. We've got to focus in on both the vega column and the implied vol column. Okay. So what I'm asking is, if our short option, the March 14th option, if the implied volatility goes down to 60, and if our long option, the March 21st 165 call, if that implied volatility goes down to 45, what will the new value of this position be? What will the new value of this position be? Again, if you're off by a couple pennies, rounding errors, I don't care. That's fine. Okay. How do we calculate that, everybody? How do we calculate that? Okay. Fair enough, Thomas. We're going to learn. We are going to learn. This is good. Bill, what do you mean is it the March 21st, 162 and a half? Both options are the 165s. The one we're selling and the one that we are buying. All I'm doing here is looking at the price of the option we're selling, which is 222. The price of the option we're buying, which is 355. That's why I have those circled to come up with our price of $1.33. Okay. Does everybody understand how our current price is $1.33 before we adjust implied volatility? Okay, good. Got to wait for some answers before I start walking through here, guys. Come on, I want some answers. I want some winners here. Got Aiden's answer. Or Aiden was just telling me the stock price or the trade price. Okay, I got John's answer. Anybody else? Anybody else here? SPY is hanging on in the green right now by a thread. We do have a correct answer on the board. We do have a correct answer on the board. Okay, so let me walk through how we do this. To figure out how the value of an option changes as the implied volatility changes, which is what this question is, we need to look at two things. We need to look in that first to the change in the implied volatility. So in our short option, which was 81%, I'm rounding off here, we're saying that it went down to 60. So a decrease of 21 points. Does everybody understand and follow that? Everyone good with that? Understands that the decrease was 21 points? Okay. Now, what Greek measurement do we look at that tells us how much the value of an option changes as the implied volatility changes? That's the vega. That's the vega. So the vega of our short option is basically 6.5 cents, 6.49. So if I take 21 times 6.5, okay, and I'm just going to round this off here, it's basically $1.37. The value of our short option is going to decrease by $1.37. Does everybody see and understand how we calculated that? Change in implied volatility times the vega. What is the 6.5? The 6.5 is the vega of that option. Right here, that's 6.5 cents for every 1% implied volatility that it moves. Perfect. Now, let's look at the March 21st. Okay. March 21st implied vol started at 58, and I asked you to figure out what happens if it moves down to 45, which is 13 points. Okay. So if we do the same sort of calculation, we take minus 13, that was the drop in the implied volatility, and multiply that by the vega of that option, which is 12.4. So if we take 13 times 12.4, round it off, the value of that option dropped by $1.61. So we've got our short option that decreased by $1.37. We've got our long option that decreased by $1.61. So the net change in the spread is a decrease of 24 cents. Does everybody see that? So if the value of the spread goes down by 24 cents and it was $1.33, that gets us to 109. We had an answer of 108, which is absolutely acceptable because there's certainly rounding errors in here. So Bill, winner, winner, chicken dinner. Most importantly, does everybody understand the steps that we just took to calculate how an option, or in this case, a position changes as implied volatility changes? Because that is really all that matters here. All right, so there we go, Tom. Okay, moving on. Before we move on, let's just do a quick refresh of our word or acronym of the day. Let you guys get that for the wheel, and we've got two more quiz questions for you. One more delta and one more vega. Lita is in the house. Lita, haven't seen you for a while. How you doing? Okay. Back to our TGIF quiz. We'll do another delta one. Okay. We'll do another delta one. How you feeling? Hopefully you're on your way to a great recovery. Okay. Here's our position. We're going to do a ratio broken wing butterfly here. Okay. So buying one of these, selling 3 of these, buying 2 of these. It's exactly what you see right here. Pay $1.10, stocks 143 and change. How do we calculate how the value of this position will change if the stock moves up to 149.68? What do we use to calculate that? Perfect. Delta. Okay. We got to figure out what the delta of the spread is. I didn't give that to you because I want you all to figure that out on your own. The information is up here, but we have to figure out the delta of the spread. Okay, so there's a hint. Here's your delta column. You can go through the math. Okay, you can go through the math. Not sure what you mean by that, Scott, if you were referring to the last quiz. Didn't matter that it said 21st or 28th. We're past that. Anybody have an answer for this one? Well, I'm not sure I remember a day in the markets that you had a monthly jobs number, the president speaking, and the Fed chair speaking. Okay, need some more answers. Yeah, triple witching. That's a good one, Gus. Need some more answers here, guys. Love to know what your thought process is. All right, S&P's right at the flat line here. Are we getting more people? Anybody out there still trying to calculate this? How many smashes do we have right now? I need 60, at least 16 more smashes before we go on to the next one. Got a bunch of answers here. We got a couple that are close that I could probably accept. So let me ask everybody right now, what is the delta of the position? What is the delta of the position? Anybody? Okay, excellent. Gene, you're spot on. Spot on. The delta of the position is 5.3-ish. How do we get that? Well, take our calculators out. We've got 41.28 on our long option, the 150 call. We're short 3 options that have a delta of 29.42, and we're long 2 options that have a delta of 26.16. If I do that all on my TI-84 or on my fingers or whatever abacus you might be using, that comes out to, and I'm just going to round it, a positive 5.3 delta. Okay? 5.3 delta. Well, if we know our delta now, and the stock moves $6.50, right? Everybody sees that it moved $6.50. That means the value of this position is going to change by about 34.5 cents, or bring it up to 145-ish. Does everybody see that? Okay, Don, I'm going to accept your answer of $1.49 because you may have just rounded off the deltas to a whole number instead of using decimals. But I'm going to give you the nod because I'm assuming that you knew exactly how to calculate this, and there we go. Yes, you did. Bingo. We got a winner. Okay. Did everybody follow that? Because I want to do one more. I know we're already at 11, almost 11:30, but I want to do one more. We will close the wheel before I do that one. But did everybody follow how we calculated the change in the value of that position? Okay. You guys are going to have about 30 seconds here, okay, to get your TGIF in for the wheel. Okay, last quiz of the day, we'll do another Vega quiz. 2 Delta quizzes, 2 Vega quizzes. Okay? Okay. In this example here, we are just buying a calendar call spread. We're just buying a calendar call spread. We're selling the March 28th 300 call, and we're buying the May 16th 300 call. We're paying $22.40. Okay, 28.05 and 50.45. So we're paying $22.40. If our short option implied volatility moves to 110 and our long option implied volatility also moves to 110, how is that going to change the value of this position? Okay, it's no different of a calculation really than what we did on the last vol. Okay, regardless of how long it might take you to figure this out, do you understand how we figure it out? I will tell you right now, 0 is not the correct answer. Zero is not the correct answer. Keep these answers coming, guys. Keep these answers coming. Don, I love that feedback. That's why you're here. That's great. Okay. 30 more seconds, guys, and then I'll go through the calc here. Any other answers coming through? Okay. We have a few correct answers in here. Not going to tell you who it is yet. Let's go through this. Okay. On our short option, the implied vol increased by 8 points, right? From 102 to 110. The Vega, 28.4 cents. So in your calculations, if you use 28 or 28 and a half, that's fine. I don't really care about that. So the change in the value of our short option was an increase of $2.27. Does everybody see that? Does everybody follow that? Paul, that's a good one. Okay, let's do the exact same calculation on the long call. Okay, so the long call, the implied volatility went up by approximately 11.4 points. The Vega is almost 51 cents. Okay, so if we take the change in implied volatility multiplied by the Vega, we get a change, an increase in value of about 581. Does everybody see that? Does everybody see that? Great. So then if our short went up by 227 and our long went up by 581, that means the net change is $3.54, which would put the new value of the spread at roughly, again, depending on rounding, 25.94. Okay, does everybody follow that? Guys, if you go into, and we mentioned this yesterday, if you go into our online campus, you will find quizzes just like this. We don't put them there just, for our kicks. Jeff understands this. Mike understands it. Charlie understands it. I understand it. We put it there so you guys can practice. Okay, so going back in the chat here, Mark, you had 2640, which is close. I'm not sure, if, and I'm just going to ask you, on the honesty end of things here, if you were just rounding and that's what you came up with and you knew the proper process. Otherwise, yes, Bear, you had the right answer, but you already won. So John Gebhardt, you were 2576, which is right there. Mark Chronister, are you still here? Are you saying that you didn't do it the right way? Because if you did it the right way and it's just a rounding error, that's fine. This is more about understanding the concept than getting the exact math down. We can all, figure out how to do math. Okay, Mark, we all appreciate your honesty. In my world, that's called being a mensch. Nicely done. So we're going to go to the next closest one, which was John Gebhardt at 2576. Guys, real quick before we go to the wheel, was something like this helpful? I know we went longer today. We can shorten things up a little bit, but was something like this helpful if we did more of these types of quiz sort of things? Because I got an email like a week ago saying, man, it would be really nice if you could just, give us some positions to figure out, which is why I did that for today. Great. We'll put that on the docket. We'll make sure we do this at least once a week with different sorts of quizzes. Awesome. Awesome. Well, Robert, the lessons are in the rooms, right? These are the kind of things we go through every single day. And this is not meant for anybody to not feel adequate about this. This is meant to just, hey, let's have some fun and learn this at the same time. Okay. All right. It is wheel time. Here we go. It is wheel time. Spin, spin, spin. Are we going to have Jonathan, Karen, Maria? Oh, she's there. Maria, you still with us? Are you still with us? Uh-oh, Maria, you've got about 7 seconds before we go back to the wheel here. 5, 4, 3, 2, 1. I'm so sorry. We got to go back to the wheel. You know, you got to be in it to win it. You got to be here. Oh, I don't know, folks. Boy, oh boy, that was late. Should I be a stickler? I mean, we all want to, it's Friday. We all want to get to happy hour and have fun and have a good weekend. I see that she's here now. Should we spin again or we give it to Maria? That's up to you guys. I'm not going to make that decision. Give it to her. Okay. Um, and yeah, Paul and everybody, you all I think know that, to review this, you can always go to our YouTube channel. All the market minds are there. All the market minds are there. Okay. Maria, you got it. Nicely done. All right, everybody. That was a great session today. I hope you don't mind that we went a little bit longer. It's all about the education, trying to mix in a little fun. Okay. S&Ps are up about 17 points right now. It's going to hold. I don't know. With this constant news source, we'll navigate through it, everybody. So I appreciate all of you. I really, really do. Mike Shore will actually be guest hosting Market Minds on Monday. Mike Shore will be on Monday. We will get the announcements out to everybody. Really appreciate all of you. Have a fantastic weekend, everybody. Thanks so much.